Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
All right, let's just start with the number, $15.16. I mean, that is the number that matters right now. That's where WisdomTree closed on Friday, January 16th. We're looking at a price that is pushing right up against the 52-week high of $15.25. But if you look beneath that headline number, the whole structure of this move is just screaming breakout. We saw a Marubozu-like candle structure on the daily chart. Now, for those not staring at charts all day, a Marubozu is a candle with little to no, wicks. It opened near the lows of 1425, and it closed right at the highs. It just signals pure, unwavering buyer conviction from the open to the close. And more importantly, look at the volume. We saw 5.81 million shares change hands. Compare that to the average of roughly 2.16 million we saw earlier in the month. This is a decisive shift from an accumulation phase where the big players are quietly buying into a full-on markup phase for a stock that's already doubled from its lows of 747.
Okay, hold on. I just can't let you frame this as some, clean, healthy technical breakout. You're looking at the closing price, which is fine, but I'm looking at the volatility surface, and frankly, it's terrifying. If you looked at the options chain for that exact same Friday expiration, we saw an anomalous implied volatility spike to 1,000% for the immediate expiration.
Well, yeah, but that's gamma.
Even looking out to February and March, implied vol is sitting at over 40%. For a diversified financial stock, that implies the market is pricing in just wild swings, not a steady climb. This doesn't look like a healthy markup phase to me. It looks like a binary event. It looks like an extreme speculative frenzy where traders are pricing in a violent move, but they have no idea if it's going up or down.
But that volatility is exactly what happens when the market realizes it's mispriced an asset for too long. The central question here isn't about one day of gamma risk or options pricing. It's whether WisdomTree is merely an expensive asset manager caught in a short squeeze, as you seem to imply, or if it has fundamentally transformed. And I argue it has. It's no longer just an ETF issuer. It is a hard money technology platform that's effectively priced like a fintech stock.
See, I come at it from a different way. To me, hard money sounds like a very convenient marketing wrapper to distract from the fact that this is a battleground stock with deep, deep skepticism. You have short interest sitting at 19.18% of the float. That means nearly 1 in 5 available shares has been sold short by someone betting the price will fall. That is massive.
Or its massive future buying power.
Let me finish. It's not just the percentage, it's the days to cover ratio, which is sitting at 8.8 days. Now, this metric measures how many days of normal trading volume it would take for all those short sellers to buy back their shares. Anything over 5 or 6 is considered high. At 8.8, the exit door is tiny. The market isn't repricing a fundamental transformation. The market is engaged in a squeeze mechanic driven by trapped shorts. You can call it a platform, but the numbers suggest it's a crowded trade just banging its head against a valuation ceiling. The hard money narrative is, it's risky. It tethers the entire company's fortune to the volatility of Bitcoin and gold rather than the stability of diversified asset management.
I see why you think that, specifically regarding the short interest, and we will get to the squeeze dynamics because I actually think the 8.8 days ratio proves my point, not yours. But let me give you a different perspective on the fundamentals driving that price. You can't ignore the organic growth. As of mid-January 2026, WisdomTree hit a record assets under management, or AUM, of roughly $151 billion. That's up $8 billion in just 2 weeks from the end of December.
AUM fluctuates with the market. If the S&P goes up, AUM goes up. That's just beta, not alpha.
But this isn't just beta. Look at the velocity of the inflows. In the entire month of December 2025, they brought in $1.1 billion. In just the first half of January 2026, they brought in $1.5 billion. They aren't just growing, they're accelerating. They're annualizing an organic growth rate well above management's own 8% target. The market is finally waking up to the fact that this company has operating leverage. As that AUM swells, costs stay relatively fixed, and profits explode. That is why the stock is re-rating. The market is pricing in a massive earnings beat on January 30th because the math simply dictates it.
I appreciate the data on inflows, and I won't dispute that 1.5 billion is a strong number. But we have to ask where that money is going. It's flowing into these hard money products, Bitcoin ETFs, gold funds. These are tactical allocations by investors, not long-term strategic holds like a standard 60-40 portfolio. Hot money comes in fast and, well, it leaves even faster.
It's not just tactical, it's structural. And this is where the thesis gets really, really interesting. I want to address your point about the hard money narrative being risky. I think you're missing the mechanism of how this stock is actually trading right now. It's effectively trading as a regulated call option on the data coming out of the prediction economy, specifically polymarket.com.
That is a bold claim. You're linking a regulated financial services company's valuation to what is, essentially a political gambling site.
It is the world's leading prediction market, and it's becoming a new VIX for macro policy. Look at the correlations. On Polymarket, the odds for a U.S. Bitcoin strategic reserve have been oscillating between 24% and 51%. At the same time, we see the odds of Kevin Warsh, who is viewed as highly crypto positive, replacing Powell as Fed chair sitting at 59%.
Okay, but correlation isn't causation. Just because two lines on a chart move together doesn't mean one drives the other.
In this case, it absolutely does because of the algorithmic traders. Here's the mechanism. When those odds tick up on Polymarket, algorithmic traders, literally machines, scraping this data in real time, bid up WisdomTree. Why? Because WisdomTree owns the spot Bitcoin ETPs and the research framework from Siegel and Gananti that supports this hard money thesis. The stock is a proxy. When the probability of a U.S. Bitcoin reserve goes up, the implied value of WisdomTree's crypto assets and future flows goes up. The market is using WT as the vehicle to trade the prediction.
But think about the fragility of that argument. You're saying the stock is up because algorithms are scraping odds from a betting website. What happens if the U.S. does not establish a Bitcoin strategic reserve? What if the yes probability on Polymarket collapses from 24% to 0? The premium in WisdomTree stock evaporates instantly. You're basically admitting that the valuation isn't based on the $151 billion in AUM, but on a speculative feedback loop. If Kevin Warsh doesn't get the job, if the reserve doesn't happen, the air comes out of this balloon immediately.
The AUM provides a floor, the prediction market provides the alpha, the excess return. And regarding Polymarket, it's not just gambling anymore. They've acquired QCX, a CFTC-regulated exchange. They have a data partnership with Dow Jones. The legitimacy of the signal is growing. The market perceives WisdomTree as the primary vehicle to express a view on sound money policy. If Kevin Warsh takes the Fed chair, that removes the regulatory tail risk for WisdomTree's digital innovations. The market is front-running that reality. Investors are looking for a hedge against fiscal dominance, and WisdomTree has positioned itself as the hard money shop.
Front-running reality is a generous way to describe a speculative mania. It reminds me of the cannabis boom or the 3D printing bubble. But let's ground this back in traditional metrics, because eventually earnings matter. This valuation is becoming completely disconnected from the pure group reality.
I have a feeling I know which peers you're going to bring up.
We have to look at them. We are seeing a price-to-earnings, or PE ratio, of over 21 times for WisdomTree. Let's compare that to the industry heavyweights. Franklin Resources is trading at 13 times earnings. Invesco is around 19 times. And those companies, they pay you to wait. Franklin is yielding 4.5% in dividends, Invesco nearly 5%. WisdomTree is yielding a meager 0.9%. Investors are overpaying for a story about hard money while ignoring the industry-wide headwinds of fee compression. Everyone is lowering fees to compete with Vanguard. Why does WisdomTree deserve a tech stock multiple in a commoditized industry where margins are under attack?
Because you're comparing apples to typewriters. Franklin and Invesco are legacy value traps. They're burdened by mutual funds that are just bleeding assets. They pay high dividends because they have no growth to reinvest in. They are managing decline. WisdomTree is being repriced because they are building modern alpha. Look at Victory Capital. They trade at 17 times earnings, closer to WisdomTree, But victory is a roll-up. They grow by buying other companies. That's financial engineering. WisdomTree is growing organically, which is much harder and frankly more valuable. But the real reason for the premium is WisdomTree Prime and their digital assets business. This business line grew from $30 million to $770 million in AUM during 2025. That is exponential growth.
It's growth from a tiny base. $770 million is a rounding error compared to $151 billion total AUM. It's less than half of 1% of their book.
It's about where it's going. You have to look at the slope of the line, not just the y-axis intercept. They're tokenizing real-world assets, RWA. They're putting treasuries and gold on the blockchain. If tokenization becomes the settlement layer for finance, WisdomTree isn't an asset manager anymore. They are a technology platform. A platform business deserves a 21x multiple. In fact, if they pull this off, 21x is cheap. It could be worth 30 times earnings.
That is a massive if. If tokenization takes off, if the regulatory environment allows it, if consumers actually want a tokenized treasury fund instead of just buying a T-bill ETF in their brokerage account, it's a massive execution risk. Right now, WisdomTree Prime is likely a cash burn. You're paying for a maybe. And while you're celebrating the PE expansion, I'm looking at the market structure, which tells me the smart money is actually betting against you. Let's look at the dark pools.
I was hoping you'd bring that up because the dark pool data actually supports the squeeze thesis.
I come at it from a different way. We established that there are 23.63 million shares short, but look at where the volume is happening. The off-exchange short volume ratio is sitting at 51.28%. For the listeners, off-exchange usually refers to dark pools, private exchanges where institutions trade to avoid moving the market price. That means the majority of the bearish positioning is happening in the dark, hidden from the lit exchange. These aren't retail traders shorting 100 shares on Robinhood. These are institutions suppressing the price.
Exactly. They are suppressing the price, but they're trapped. This is the definition of a coiled spring. Let's go back to that days to cover number, 8.8 days. That is an eternity in trading. They are in a burning building with a very small exit. The fact that over 50% of the volume is off exchange means there is a massive block of demand that hasn't hit the NYSE order book yet. Think about the catalyst. We have earnings coming up on January 30th. Given the $1.5 billion in inflows we discussed, a revenue beat is highly likely. If that positive news hits, those institutions in the dark pools have to come into the light to cover their shorts. When they try to buy 23 million shares in a market that usually trades 2 million a day, you get a violent vertical move. That is the mechanics of a squeeze.
That is the standard short squeeze pitch. It's seductive. But if the squeeze is so imminent, and if the hard money thesis is so robust, why is the call coming from inside the house?
What do you mean?
I'm talking about insider activity. We have seen Form 4 filings showing CEO Jonathan Steinberg and executive Alexis Marinoff selling shares. If the CEO thought the stock was about to rocket to $18 or $20 because of a short squeeze or a Bitcoin reserve, he wouldn't be selling at 14 or 15. Insider selling into a breakout is a classic signal that management believes the stock is fully valued. It contradicts your narrative that the smart money is buying. If the people running the company are selling, why should I be buying?
That's an interesting point, though I would frame it differently. Executives diversify. The stock has doubled in a year. It was at $7.47 not long ago. Taking some chips off the table is rational financial planning, not necessarily a lack of faith in the business. They have huge exposure through options and unvested shares. And speaking of smart money, you can't ignore Two Sigma Investments. They increased their position by 297.3% in Q4. That is a premier quantitative fund. Their models are picking up on the flow momentum, the volume, and the breakout. I will take the signal from Two Sigma's massive buy order, backed by their algorithms and deep research, over a standard executive diversification sale. Two Sigma doesn't buy that aggressively unless their models see a statistical edge.
Two Sigma's chasing momentum. Momentum works until it stops abruptly. Quant funds are trend followers. They aren't value investors. And that brings me back to the technicals we started with. We are banging against 1525. This level has acted as a ceiling. The implied volatility is pricing in a massive move, sure, but that move could easily be down. If the earnings report on January 30th shows that expenses have risen alongside AUM, that the operating leverage you mentioned isn't actually there, because they're spending a fortune on Wisdom Tree Prime marketing. This stock has a long way to fall. The support is back at $13. The risk-reward here is asymmetric, but not in the way you think.
I disagree on the support level. I think the breakout above $15.25 is technically uncapped until we hit the $17 to $18 range. The volume we saw on Friday, nearly 6 million shares, tells me the buyers are finally overwhelming the sellers. The short interest isn't a warning, it's fuel. It is the dry powder for the next leg up. The market structure is set up for an explosion, and the fundamental catalyst is that record $151 billion AUM.
So we agree then that earnings call is going to determine everything. We need to see if they can prove that operating leverage. Can they handle this growth to, say, $200 billion in AUM without cost spikes? If they can't, the fintech valuation multiple collapses.
And I believe the data suggests they can. The revenue beat is almost baked in with these AUM levels. The real question is the guidance. But with the poly market odds providing a tailwind, I think the path of least resistance is higher. My conclusion is that the acceleration of inflows to $1.5 billion in just 2 weeks supports the price. The breakout above $15.25 is imminent, and I view the short interest not as a warning, but as the fuel for the next leg up to 18.
And I just don't see it that way. For me, the risks are asymmetric. The stock is banging against the ceiling at $15.25 with massive implied volatility. The insiders are selling, the technicals are screaming overbought, and the hard money bet relies entirely on regulatory wins, the poly market odds staying favorable. We will see what the vote is on January 30th.
Indeed, we will.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya!